Interest rates play a crucial role in the financial lives of Americans. When the Federal Reserve raises interest rates, the effects ripple across the economy, influencing everything from mortgage payments to job opportunities. But what does an interest rate increase mean for the average person? In this article, we'll explore how higher rates impact consumers, businesses, and the broader economy. Why do interest rates rise? The Federal Reserve, also known as the Fed, raises interest rates primarily to combat inflation. When prices rise too quickly, increasing borrowing costs help slow down spending and economic activity. While this strategy can help stabilize inflation, it also has unintended consequences that affect millions of Americans. Impact on borrowing costs. One of the most immediate effects of higher interest rates is the increase in borrowing costs for consumers and businesses. 1. Mortgages. If you're planning to buy a home, expect higher monthly payments. A rise in interest rates can add hundreds of dollars to a mortgage payment, making home ownership less affordable. Existing homeowners with adjustable rate mortgages, ARMs, may also see their payments go up. 2. Credit cards. Credit card interest rates often follow Fed rate hikes, making it more expensive to carry a balance. For those already struggling with debt, higher rates can make paying off credit cards even more challenging. 3. Auto loans. Higher interest rates mean increased monthly payments for new car buyers, reducing affordability and potentially slowing car sales. 4. Student loan. Federal student loan rates are fixed, but private student loans with variable rates will become more expensive, putting extra financial pressure on borrowers. Savings and investments. While borrowing becomes more expensive, savers can benefit from higher interest rates. 1. Savings accounts and CDs. Banks typically offer higher yields on savings accounts and certificates of deposit, CDs, when rates rise, allowing savers to earn more on their deposits. 2. Bonds and stocks. Rising interest rates often make bonds more attractive as they offer better returns. However, stock markets can become volatile since higher borrowing costs can reduce corporate profits. Housing market slowdown. Higher mortgage rates can cool down the housing market. Fewer buyers can afford homes, leading to slower home sales and potentially declining home values. For current homeowners, this could mean their property values appreciate more slowly or even decrease in some areas. Job market and wage growth. Interest rate increases don't just affect borrowing and savings, they also influence employment opportunities. 1. Business loans. Companies that rely on loans to expand or hire new employees may cut back on growth plans due to higher borrowing costs. 2. Layoffs and hiring freezes. As companies face higher expenses, they may slow hiring or even lay off workers to maintain profitability. 3. Wage growth. A cooler job market often leads to slower wage increases, making it harder for workers to keep up with inflation. Impact on everyday expenses. Higher interest rates can lead to lower consumer spending, which in turn affects businesses and the economy. When people cut back on purchases, businesses may respond by reducing prices or offering fewer goods and services, which can lead to economic slowdowns. Who is hit the hardest? While interest rate increases affect everyone, certain groups feel the impact more than others. 1. Young adults and first-time homebuyers. Higher mortgage rates make home ownership less accessible for those entering the market. 2. Low-income households. People living paycheck to paycheck face greater challenges as credit card and loan payments rise. 3. Small business owners, entrepreneurs who rely on financing to grow their businesses may struggle with higher loan costs. The long-term picture. While higher interest rates can be painful in the short term, they are often necessary to bring inflation under control. If inflation stabilizes, the Fed may eventually lower rates again, making borrowing more affordable in the future. However, the timing of such adjustments depends on how quickly inflation slows. What can you do to prepare? With rising interest rates, here are a few steps you can take to protect your finances. 1. Pay down high-interest debt. Prioritize paying off credit cards and other variable rate loans to avoid higher interest costs. 2. Lock in fixed rates. If possible, refinance loans to secure lower fixed rates before further increases. 3. Increase savings. Take advantage of higher savings account rates to build a financial cushion. 4. Reevaluate investments. Consider how rising rates may impact your stock and bond holdings. An interest rate increase has wide-ranging effects on American households, businesses, and the overall economy. While savers may see benefits, borrowers and consumers will likely face higher costs. By understanding these impacts and preparing accordingly, individuals can navigate the challenges of a rising rate environment more effectively.